Okay, we're recording again. Um, I specifically wanted to talk about the risk management scenario and decision making that Scott and I did yesterday with FedEx, and how you know you how almost how to put your gut feeling into numerical form. Um, but before that, if anybody has any questions about anything in general, by the way, if the new people that are in the room, if I have not introduce myself or at least reach out to you. First, our apologies. Second, please feel free to do so. Um, the three places that you want to, if you have to or want to get in touch with Scott and I personally while we're in the room, there's three places that either of us can be. You can private message Scott over on the left-hand side and just go under Scott Bauer. You left click and you hit private message. If you want to do me, then you just go to Michael Shorr, left click and click private message. Then a chat box will jump up on your chat. In the Amnovia session, you can just sit there and type like you would be chatting with anybody like anything normal. The third place is, if you'll see something that comes from here, where I just said hi, that comes from the options administrator, which we have three trading stations that Scott and I work from. This is the one. Hey, see, there's Scott. So, so Scott is on a different machine than this one, and I happen to be moved over from where I normally am. And this is kind of, I don't know if you want to call it mission control or whatever. This is where we project the room, and if one of us is talking or explaining something or doing some demonstration or whatever, this is where that comes from. So if you're private messaging me and private messaging Scott, and you're like, geez, none of these guys are getting back to me, um, try private messaging here. Yeah, yeah. I mean, we've both been to the padded room, I believe, more than once. I think being in this business, you kind of have to have your own padded room for your own safety and others. But and also, we don't use it a lot, but if you guys want to, you certainly can. We can grant you microphone access. So for open discussions on things like this, where people either they don't like to type, or maybe they're not able to type, or it takes forever for them to do so. If you have a microphone that is working and integrated with your system, we can grant you mic access just like we are now. Right now, yeah, and Scott's right. It is always nice. I mean, it's nice when people come in for fly-ins and visit with us, and we're able to put a face with the chat, because some of the people in the room, we interact with a lot on a daily basis, and we've never really met each other other than you guys getting to hear our voices and us being able to imagine what your voice sounds like and everything like that. So I mean, when it comes down to it, yes, this is our profession and everything, but at the end of the day, we are all human beings, and we like being around people that we like. So um, getting on and having that added level of whatever you want to call it, interaction or personal reaction, I think it would be great. And if not, that's fine. Um, as far as putting out questions, feel free to put questions in the general chat. Some people either maybe they have a specific question regarding, dollars and cents, and they don't really want to put that out in the room, but they don't mind talking to Scott and I about that. And I totally get that, when we're talking real money, maybe you don't want to advertise either how much you're making or how much you're losing. I totally understand that. So private messaging Scott and I probably would be a better idea there. Um, but if it is a general question and you think people might be able to learn from it, I would certainly encourage you to put it out in the room. So if that is so, does anybody have any questions at all about? I mean, even I don't understand why I'm getting the emails. I'm not getting the emails. I can't log into the TA app. So those of you with iPhones, there's a Trading Advantage app where you can get the signals as well. Yeah, that's funny. So, things like that, or if you have basic option questions on theory, we can talk about that. We can talk about our methodologies and why we do certain things. Or, like I said, I have some, I wanted to go over, one of the big concepts that we talk about, or that we employ here that a lot of people, don't really take into consideration. Well, if there's no questions, we can move on to that. I'll give you guys a few seconds to see if your thoughts, and I'm going to grab a quick drink of water. I'm here. I'm just reaching over to my other desk. Okay, well, I don't see anybody with any questions right now, which is perfectly fine. And realize that this isn't the only time during the day where you can ask questions. It's a constant question and answer session. The only caveat that Scott and I'll say is if we're busy, we're not going to be able to, if you ask us a question at 8:31 in the morning, either private message or out in the class, we may not be able to get to it until later, even much later, because that's when the market's opening up. That's when we're trying to figure out if there's any actions that we need to take. Is there any opportunities that are opening up for us right now? So typically, this is kind of the time of day where things slow down and we at least have a good chance of being able to not be busy doing other stuff. Okay, so the concept that I wanted to talk about and which came into direct use yesterday is the concept of expected value. And we touched a little bit about it. I want to say late last week when we had talked about the different reward to risks that different options or option spreads allow us, and how you can give yourself a lot of reward to risk, but that reward to risk has to be taken into context. You know, my ability to throw a baseball. If I ask an odds maker, my ability to throw a baseball, from a major league pitching mound at 100 miles an hour, I'm going to get fantastic reward to risk, right? Somebody's going to say, I don't care how many times you throw this ball, Mike, you're not going to throw it. When when you were at your peak in your baseball career, which ended shortly after high school, I could throw the ball probably 70 miles an hour. Now, 25, 30 years later, I don't think that that you're going to be able to do that, and I'm going to say I'm going to give you 1,000,000,000 to 1 odds that you can do that, or whatever it is. The thing is that any money that you allocate towards that trade signal from that end would be wasted money because I can't throw a fastball 100 miles an hour. So just because something has a high reward to risk doesn't necessarily make it. Looks like we're selling a little bit more Adobe here, one lot at a time. So we come into in when I say that reward to risk has to be taken in context, that brings into the concept of expected value. And I made this small on purpose because I have some other stuff here I don't want us to get ahead of. So what you have to do with expected value is, let me see if I can make this bigger. No, you guys can see that as well as you can see anything else. You can see that. Is expected value is taken the odds of something happening, and then the dollars associated with it. So if we were to play a game where you give me $1 and we flip a coin, let's do that example. Okay. Well, first let's go over what expected value is. The the probability of event A, whatever event A is, times the cost effect, making or losing money, plus the probability of event B happening and that cost effect multiplied together, plus however many different scenarios there are. The easiest concept would be something like, let me get a new one up here. All right, so here's a new one. So let's play a game. So let's play a game. I'm gonna flip a coin. Okay, you are gonna pay me $1 to play the game. Okay. Let's see if I can make this whole thing dollars. Okay, you pay me. If heads come up, you win $2. If tails come up, you win $1.50. Or let's just say let's make you only make 50 cents. Okay, so now you have to ask yourself, what is the expected value of any given flip? So we have two events here, right? This is event A, heads. And then event B. So now we have to say expected value is equal. Excuse me. Let me pull this here. Okay. So our expected value is equal to the probability of A. What's the probability that comes up heads? %, exactly. What's the cost effect? I'm sorry, if it comes up tails, you're going to owe me. No, you're going to make 50 cents. Probability to A. And then the cost of A. The cost of A, we already said, is you're going to make $2 positive. Okay, now the probability of B, it's just going to be 100% minus the probability of A, which we know is 50% again. And the cost, and I'm using cost in absolute terms. I know that we're making money here, is 50 cents. So then our expected value here is going to be our probability of A times, too much. It's going to equal the probability of A times the cost of A plus the probability of B times the cost of B. So our expected value is $1.25. Does everybody see how I got that? Does anybody not understand how I got that? Does everybody see? Would you play this game or not? Scott says he wants to play. Okay, Sanjay wants to play. Exactly, right? Because you're paying $100. Your expected value from this thing, if you trust these probabilities, I already told you. I mean, these are absolute. You're going to make $2 here. You're going to make 50 cents here. Now, if your probabilities, if you say, hey, listen, this guy could be using, a fixed coin, and let's just say it's 30, and now I should have made this 100 minus that. Excuse me. Well, now, if I'm using this fixed coin where probability of A, where you get the $2 payout, is only 30%, that means 70% of the time we're only going to get the 50 cents. Well, now my expected value is 95 cents. Now, the cost of B isn't a -5. If it comes, you're paying me $1. If heads comes up, you win $2. If tails comes up, you only win 50 cents. Your expected value here is 95. So here's a game you wouldn't play, and this is the one where where the carnival comes in, and they're using a loaded coin, or they mess with the payouts here. They make the probability of A seem really really good to you. Yeah, I can throw that hoop, and make it go over the thing. So this has an expected value of 95 cents. So so your ability of how much edge you need to play this game is dependent on how many times you can do it, right? I don't mind that my expected value here, let's just say here, is $1.25. Let's just say that I only make $1.75, okay? Or let's say $1.55. I don't mind that theoretically, if I trust that we're using something that truly does have a 50-50 chance of happening, that your expected values, I'm only expected to make 2.5 cents for every time that we play this game. If I can play this game once, I need more edge to play this game. I need to have that $2.50 scenario. I need to, say I need a chance of making 25 cents on my dollar risk. But if I can play this game a million times, and from a statistical standpoint, I make 2.5 cents, as long as my transaction costs aren't so high, I'll play that game. But given once, really, statistically, it's valid for me to play that game because, hey, I can make 2.5 cents. But by the time that we finally play this game and all this other stuff, is it really worth the 2.5 cents for me to do it? Probably not. Okay, so now. That's just expected value in general. So now we have to look at so here's more of the scenario that we had yesterday. We had the expected value, same thing. And we got into FedEx. Some people got in for 110, some people got in for 115, but let's just say 115. And we were looking at the prospective exit of getting out of this thing before earnings without having to take the risk at $1.75. What would you do? Now, there's no, we don't have a crystal ball, right? And so we can't know what all the different scenarios are or necessarily what all the cost parts of it are. So we're talking about something that isn't as concrete of I'll pay you this much if this happens, and as far as as things go, let's just say that flipping a coin has a 50-50 chance of coming up heads or tails. We can argue if that happens in the real world or not elsewhere. But what do we do? Well, now we have to say, okay, we have to come up with ourselves of what can happen and what do we think will happen if that does happen. And so, and this is where you're putting subjective thoughts and subjective assumptions on yourself to a real world environment, which, this is what modeling is, right? Otherwise it would be, be a rule. Okay, and so what I said here, let's see. Sorry, I'm making this just so we don't get ahead of ourselves. What I said is that there were three prospective things that could happen. We could go down a little, and we can go down a lot. We can go up a little. The spread can go to the max area, which would be what was that one? What would we have? The 52.5, 57.5. So that would be, if it goes to the max, it goes to 57.5. And then if it goes to the moon, if it goes to 160 or above. Knowing that we already had profit in this thing of 60 cents. In at 15, out at $1.75. Everybody knows what the expected value of that is. It's 100. If we sell it out at 175, our expected value is a profit of 60 cents. So now you have to say, okay, what is, now this is subjective, what is the price effect of each of these scenarios? Well, if we go down a little, I was saying that maybe this spread goes from 175 and down 50 cents, so it's down 125. So you're still profitable. Remember, we had this run up, maybe that was a, buy a rumor, sell the fact, who knows? And you could argue that I don't think we're going to lose that much, or you could argue I think that we're going to lose more. And we can argue that. I don't want to though. We could go down a lot, in which case that we would the $1.75 that we had in this thing, we would lose it all. And now this is the expected value, not money made. If we go up a little, I think that we could have made maybe 30 cents more. You could argue if it's more or less. If it goes to our spread max, I think we could have made $1.75 more. We're not going to sell this thing at the maximum value. Everybody knows that. Even if it goes there right at expiration, you don't get to sell it for the max, but maybe make $1.75 more. Or if it goes to the moon, then I said, okay, we're gonna make our $1.30, which the whole thing paritizes out. Then you have to say to yourself, okay, now you have to assign a probability to this, and I just put, go up a little. That was my second biggest probability. I said, maybe a 25% that we go up a little, and by a little, I'm not trying to quantify it. If we go down a little, that I said 37.5. That wouldn't have surprised me if we went down a little because we ran up yesterday. Maybe it's a benign number. People don't really want to take a big risk on this stuff going into FOMC. Go down a lot. I mean, we wouldn't have had a bullish signal if I didn't have some, thought that we were going to go up. So going down a lot, I gave a shorter, a smaller probability. Go to the spread max, about the same as that, and then go to the moon, same as that. But here, so the upside, even though we had a move to the upside, I still have, basically we have a 50-50 shot even after the move up. And so then it's just a simple exercise of saying, okay, we have what we deemed the price effective things. We deemed what we feel the probabilities of are. We multiply this times this, 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 which is here, add them up, and your expected value is that you're going to make 5 more cents. So, and that, granted, I didn't do this exercise yesterday, so there is a little bit of a rear view mirror thought to this, but what's more important is not trying to validate what we did yesterday, but it's to try and put down into numbers what you think, I have a hunch. And we do have an expected value calculator out there in the, which is, it's very simple. It's in the Documents tab, but if you want to play around with that, and you could say, well, Mike, if we go down a lot, maybe we don't lose our entire thing. We only lose, maybe we only lose $1.50. Or maybe we only lose what we had into this thing, $1.15. Okay, well now you're looking at making theoretically 12.5 more cents. Is that worth it? Or is it worth it just to take the risk off and take our 50 cents and go home? 60 cents and go home, excuse me. And or if you say, you know what, and remember this thing always has to equal 1. Be careful with that. So let's say, Mike, I don't think that we're only going to go down a little. I think that there's only a 12.5% chance of that, and I think that going up a little is actually a 50% chance. Well, now you're saying, okay, well, instead of taking 50 cents profit, 100% sure, I think that we can make 82.5 cents total. Well, then that's something that you have to weigh. Whatever your risk tolerances are, that's what dictates it. And I think that we've been pretty consistent that when we have, and there's no hard line in that, but when we have decent profit into something where we do something before earnings and somebody's letting us out we tend to take that off. Now, if we buy something for 35, are we going to sell it for 45 cents? No, but if we buy it for 35, would we sell it for 60? Probably. If anybody is, has been following us, probably. Do we have a reason why we want to keep it? Maybe we do. But this is kind of, getting into the subjective nature of the math. And really, this calculation is only as good as your ability to model these different inputs, which, and you have to be careful. You have to be honest with yourself about, not what I hope what happens, but what do I really think you know, in, if I'm being honest with myself, what do I think happens? What do I hope happens? I hope we go to the spread max and make this, a total max out, and that's 100%. Remember, we don't deal in possibilities, we deal in probabilities. Peter, I see you typing. Welcome the question or comment. Well, letting your winners run to what point? I mean, the if you could say you you can't do it forever because this isn't a stock. This is an option that has a time constraint to it. So letting it run is, yeah, well, and that's and Sanjay, I've talked about this before. Is that you either become either overly afraid or overly confident because of what's possible. You wouldn't leave the house if you thought it. If you assigned normal or abnormal probabilities to improbable events. Well, I could walk outside and I could get trampled down by an elephant. Well, getting trampled down by anything is probably remote here in Chicago's Loop, and unless an elephant gets out from one of the two zoos here, I'm probably not going to happen. But if I've convinced myself that that's a real possible, that's a very not only is it possible, it's quite probable. That's where you get your Howard Hughes of the world that don't leave their house and walk around with Kleenex boxes on their feet. And as a trader, there depending on what where on the spectrum you are as far as risk averse or risk non averse, you may not be assigning the correct probabilities to outcomes. So that's where when a trader a trader who has a lot of experience says that my gut just tells me A, it's probably because somewhere in their subconscious they've done this calculation in their head, and this number is not big enough for them. Now, if you sit down and also, but and we talk about this hiding behind the math. Like I said, I can make this look as good or as bad as I want, and I can sit there and I can wave my spreadsheet, at the marketplace, telling the marketplace that it's wrong. I have a spreadsheet to prove it. Doesn't mean anything. It's just it's just a way to organize and to somewhat validate your approach to something. And that's the exercise that Scott and I in our heads did yesterday. And I thought this morning, let's go through what I really thought. And I was trying to be as honest as I could, knowing that I what I knew this morning, which is you could say is, well, that's not possible. No, it's not possible. But if I'm trying, I'm not trying to prove a point. I'm trying to show an approach. So that's a big concept that we want to bring in, and it ultimately comes into most, if not all, of the decisions that we have. It's a way of us. We say it's all about risk to reward. It is, and but risk to reward isn't just what can I possibly make and what can I possibly lose. It's also about, given that scenario that we know what the best and worst case scenarios are, what is the probabilities of each of those? That's the art. The science is, I know how much a spread can be worth. I know how much I can lose if I buy it. That's the best case scenario and worst case scenario divided by each other. With the earnings report coming out pre-market, you're locked into your position if you carry it overnight. Yes, that's why we sold it yesterday. That's why we were faced with, you know, a good scenario that we were bullish on FedEx. The market apparently agreed with us after we got in. FedEx rallied, and we had the possibility of getting out, and we had to decide whether we wanted to do that or not. Well, maybe take the profit, but how much profit is enough? Everybody has their line in the sand. Everybody has their number. Like I said, if we bought this thing for $1.15, would we have sold it at 120 yesterday afternoon? Categorically, if you ask Scott and I, we would say no, unless we had a reason to believe otherwise. But that's just that, it's just too little reward for the risk that we already took on. If we were going to do that, we probably shouldn't have done the trade in the first place. So just taking profit is dangerous too. People that are unable to realize their losses can be almost as dangerous as those that take their their profits too soon. If I take every winner that goes up 10% off and every loser I let go to zero, you're going to lose. Why? Because you're letting your losers go way too long, and anytime you get any money in your profit, any money in your account, you take it off. You're going to lose doing that. But I mean, if we made the 50 cents, you know, without having to take the additional risk of earnings, we had a 43.5% winner. Is that our loose guidelines? Are to start looking at profits depending on the type of signal it is at like a 70% winner for a directional play. But this was a directional play into earnings that we already had money in. Okay. Any other comments? Any other comments on this? Obviously, if anybody has something else they want to talk about, I'm all for it. It's 11:30. Actually, I have to go and meet with some of our new people about some stuff. So actually, I have to go for about 15 minutes or half an hour. But Scott's here. We're here. I'll have the room up. I'm just going to be talking about different stuff. And